and I'm kind of forcing them. I'll say, hey, you're only going to get 2 trades today, and you're only going to go for 2R on every trade, period. That's all you get today. And it's a drastic punishment. So one of the things that I like to do when I'm working with somebody and they have an issue we start having trouble with their hit rate, and I really just want to decide how well they enter trades. I'm not worried about how well they profit or how well they do any of the backside. I just want to see these entries, and I'm kind of forcing them. I'll say, hey, you're only going to get 2 trades today, and you're only going to go for 2R on every trade, period. That's all you get today. And it's a drastic punishment. And one of the reasons why, and I bring it up often, is because when you're trying to be a successful trader, there's really only 2 ways to be a successful trader as far as consistently goes. You either have to have a very high hit rate, right? So you're very good at reading market movement and you win more often than you lose, or you have to have a very high reward rate. There is no way to be a successful trader with a low hit rate and a low reward rate, right? So that's why the punishment exists, right? Because I'm saying you're only going to get 2 to 1, and I'm only going to give you 2 trades, right? So it's basically like, it's a horrible thing to do to somebody, because at best, they're going to get 4R if they win both trades, so you're really crippling them. But the exercise is to teach them, because a lot of people, when the market gets difficult, they will say things, the market looks difficult, so I'm going to put my scalping hat on, right? And I'm going to go for tight entries, and I'm going to go for small moves and small profit, right? So you're going to take a hard day, and you're going to take a statistically insanely difficult aspect, right, and combine them together, right, which is going to absolutely destroy you. It's going to be very difficult to succeed in there. If it's a hard day and it's a day you really don't like, you either don't trade that day, or if you are going to trade, use wider stops and go for longer targets, right? Which is completely the opposite of what people think. But on a harder day, you should be more risk adverse, right? And staying back on the days you recognize that things are going, these are the days to get quicker profit, and these are the days to go more aggressive. So it's a little bit backwards. So that's why I kind of bring that up, but it's really a punishment tactic. Ideally, if you're doing it right, you want to have anywhere north of a 40% hit rate, right? And you want to run around 4R to 5R target on your trades. If you are hitting, hold on, let me go ahead and get my screen share up. Present now. We're going to do a little webinar. I got time. Let's do this. Hold on. It's this chart right here. So if you so basically, like, you cannot be successful, right, if you have a low hit rate or a low reward rate, right? It's just not possible to be profitable unless you run a 60 or a 70% hit rate. For the record, I run a 70% hit rate, right? So if you, after 5 to 6 years of trading, like I have under my belt, feel like you've got a 60 to 70% hit rate, then maybe you should start going for 2 to 1s. For the record, I don't go for 2 to 1s, right? I like to go for 4 to 1s or 5 to 1s. Why? Because at 4 to 1 or 5 to 1, even at a 40 to 30% hit rate, right? Let me get my favorite color up here. Believe it or not, one of my favorite colors is pink. Anywhere in this 30 to 50% hit rate, right? At a 4 to 1, I'm profitable anywhere north of 30%, right? Breaking even at 20%. So statistically, this is really going to be your sweet spot, is to be going for 4 to 1 in your trade. So if you're going into if you're risking $25 on your trade, you should be aiming for $100 on that trade, right? And if you're nailing that consistently, and you can hit 2 out of every 3 trades, or somewhere north of like that, you will find yourself in what I like to call trading nirvana, right? Which is where you're just going basically day after day after day, sitting in the green zone. And the reason why is because on your days you struggle, right, you'll come down to here, right? So you'll kind of close your day out slightly red, if not break even. And then on your winning days, you'll most likely rock and roll somewhere up in the higher percentile, 4R, 5R, 6R, even more. We have really nice days where we really nail some of these trades, and you can pull 20R, 30R out of a really good runner if you let it go. So which we had a couple of those We bought S3 on ES when it was down there earlier in the month, right off of the bottom, and we just stuck that thing on. And my buddy Mark, who I love and hate for it, rocked some full-size ES contracts and swung them for the majority of that rally. So one of these days he'll remember me, and it'll be really nice. Anyway, all right. So let us go ahead and move on to the concept of market auction theory. I'm not really sure why there's an arrow there. Now it's gone. So market auction theory is a fascinating concept that I've been obsessed with since much longer than I've been a stock trader. It's a concept that helps us understand how the stock market works. The goal is to find fair value of a stock, which is the price where the most trading activity will occur, right? So a lot of the times when you're moving up and down, you're moving up and down from areas of high value through areas of low value to areas of high value, right? Think of it like a giant flea market where the people are constantly haggling over the price of items. Right. The stock market works in a similar way with buyers and sellers negotiating. When the market is balanced, it means the price is fair. And there's a lot of trading going on. But when the market is balanced, the price doesn't move a lot. Right. When the market is unbalanced, that means the price is unfair. So it's too high or too low. So there's less trading happening in that area. So the price will move somewhere else. Right. So we go from areas of high value, moving through areas of low value to areas of high value. So this is when we talk about order book reading and stuff like that. This morning, you'll constantly hear me reference the rule of thumb being price moves to size. Right. So, and this is what we're talking about. We're moving to an area of high value. Why do we go to an area of high value? Because market makers are incentivized to transact there. Right, a market maker is like an ATM machine, right? An ATM machine doesn't make money with cash shoved inside of it, right? Market makers don't make money with stock shoved into their warehouses, right? ATMs make money when someone goes up to that ATM and sticks a card in it and pulls $20 out and gets and they get a $2.95 charge. A market maker makes money that way. Every time you do a share, you exchange a share, right? There is a flat fee that you are getting charged for that activity. The market maker gets that, right? It doesn't matter how small your transaction is. They actually get a pretty standardized fee every single time. That's why if you're using tiered commission tiering, it actually benefits you to trade more shares because your commissions actually get cheaper the more shares you take in the tier. Right? Because you're already paying the flat fee for the first couple of shares. Why not go ahead and throw a couple thousand more on for a rebate? Right? So now market makers are also incentivized with rebates. Right? These market makers, as they're doing these transactions, are actually preferential market makers are actually getting kicked back money from the NYSE in order to bring traffic into the flea market. Right? So market auction theory is important because it helps us predict how the stock market will behave. It's by understanding the dynamics of supply and demand, we can make better decisions about when to buy and sell stocks. So it's like being a master chess player who can anticipate the opponent's moves before they happen. So in a nutshell, market auction theory is all about understanding how the stock market works and using that knowledge to make smart decisions. This subject, it can be really fascinating when you get into it. So I talk about a flea market. This is the flea market you're participating with. This guy over here to the left used to have a lot more hair at one point in time. Apparently being a stock trader makes it fall out. But you can see over here, this is the NYSE floor. These are all the various booths where there's market makers all dialed in. Right, you can see all of this area over up in here. For anyone who's actually interested in some history, the balcony that this fine-looking gentleman here is standing on top of is the same balcony if you saw the pictures of the women's suffrage movement. The big photo where they're all lined up together and they're taking the photo as they overlook the exchange. This is exactly where they were standing. right? So you can see here, though, that this is the market that we're participating with. And this is a real live auction with people walking from these broker desks right out to market makers on the exchange, making off the book deals back and forth, stuff you're never going to know about till it happens. So how do you know it happens? Volume, right? Theory, right? So to understand the movement of stock prices, you must first understand why and how they move. The market has a psychology to it that is extremely organic and emotional. The market is made up of traders, and you must remember that. Every single order going across the market is made by someone. Even the algos that trade are programmed by people. Therefore, they carry the emotional bias of those programmers into the programs themselves, right? As we move forward, we're going to be discussing the theory behind how and why the market moves, market auction theory. My goal is by the time we're done here, you're going to look at the market in a little bit different of a way. No longer see bids and asks, but see buyers and sellers, competitors fighting an epic battle where the winners get rich and the losers go broke. The information here applies to any market where supply and demand is in use. In this instance, we're obviously going to apply it to the US stock market. So this is what we're going to try and get through right here. A little bit of the stuff going on. Should be a pretty good time. So as I mentioned before, right, the stock market is nothing more than an auction. Many auctions happening in an auction, right? Every single ticker that you're looking at is an individualized market within the broader market. So when we're talking about the market or the stock market, remember the first market you're actually dealing with is your market of the ticker you're in. Apple, for instance, is a market, right? There are market makers making the market of Apple, but Apple is a market that is listed within another market, right? Apple is within a larger, a NASDAQ composite or an S&P, right? Every ticker is listed within a larger market. Any one of these variables can put pressure or change what the overbearing participants are viewing of it. Now, with the market, one thing we recognize, right, is that the market does the same thing over and over and over again, constantly reacting to value, right? But this isn't just a principle like for financials of the market. This is people in general, right? This is politics. This is real estate. This is any kind of market. This is any kind of participation-based entity, right? Imagine a pendulum. Pendulums ebb and flow as they come from the middle area, banging back and forth, right? Value does the same, right? As you come back into value, you don't just hit value and stop, right? You go to value, you hit value, and you have to go slightly beyond it. And then you come back to it and you go slightly beyond it. And you do that over and over again until you find fair value, right? Or you find value, which is what we're going to talk about here, where we're going to talk about balance and value. You go into balance, which means you start to consolidate. Your volume drops. Things get really low. The pendulum swings very little, right? And it swings very slowly, right? But in time, the pendulum will speed up and it moves and it keeps going over and over again until eventually we swing so hard in one direction, the ball flies off. Right. And that's when we go into movement, and that's when we go in other directions. So when we're going through the auction process, you're constantly need to be dialed into or weighing into what part of the process are we in. Yeah, Brandon.
How do you find what you're going to be looking for, or what's in play for you? Or do you just develop, okay, I'm going to watch this because I understand its pendulum movement? Like, I know you transitioned from mostly equities to the futures. The SPY, was that, I mean, do you just follow, like, how do you find out?
So this is going to be the same as we go through here. This isn't just for the stock market. This is for every market. This is market theory. So this will work on SPY, Qs. This will work on the real estate market. I actually I'll talk a little bit about that in a second, actually on the next slide, on how this relates to a broader market. Because the first thing, in order to understand where a stock is going, you need to understand how it's being valued. Right. A lot of the times we get obsessed with patterns, but patterns are generically an after effect of what has already occurred in the order book. right? It's one of the reasons I can tell you if a pattern is going to fail or not, or is going to work or not before the pattern even happens, right? Because I can read the order book and I can read the volume that's going into the order book. So I know how much participation we're having, and I know, does it look like we're getting ready to move up or move lower? And now the auction process lets you understand what part of that movement you're in. So let me expand a little bit and then hit that again with me at the end if I didn't clarify it enough for you. So basically the easiest way to explain this, right, is when it starts off, think about this in the beginning. When the stock or when the market opens, you're going to open in what we call the price discovery phase. And some of this I'm going to double hit because I'm going to kind of jump a little bit ahead. So the price discovery phase, or what we call is an imbalance phase. This is one of the reasons why the opening range can be so difficult to play unless you really like kind of get a feel for the rip and pull that goes, because you're basically opening up in an area where there's not a lot of orders on the order book yet, right? So you haven't really discovered where these value areas are, and you haven't seen price occur. So you're in what we call the imbalance phase. You're going to auction in the imbalance phase with a lot of erratic volume until you establish value. Value is established by orders, plain and simple, right? Value can be established over time, right, by price. So hitting the same price over and over and over again over the course of an hour to 2 hours to 3 hours, right? Or value can be established in an instant by hitting one really gigantic order, right? Sometimes, and we call these climactic events, right? It's buying up, and all of a sudden you just smash into a seller. And that's like being at an auction and somebody raising their hand and saying, sell them, you know, like they're just screaming in the market. This is it, boom. And no one's going to start buying after that. The market imbalances the other direction, selling ensues, and now all the participation is to the sell side, and we actually start to auction lower. But we'll go through these phases. So part of the reason, one of the ways you'll know, is it time to play this break up? Is it time to play this breakdown? Will be by paying attention to what part of the auction you're in. If you're in a balanced part or a value stage of the market, you really don't need to participate with it all. It's not going anywhere, right? It's going to actually stay there and chop forever, right? Until the state of the auction changes in some way. And this is good to know, because if you're a momentum trader, especially, and you're looking to get into a stock and make some money pretty quick, the last thing you want to do is get into a stock that's going to spend the next couple of hours not going anywhere. And we actually talked about this at PCT this morning as well, right? One of the things we were looking for this morning is we were planning on waiting till 10 o'clock, were we not, to see what the market was going to do, because we knew with the news events coming out at 10 o'clock, we probably weren't going to get any substantial movement until then. Sure enough, 10 o'clock came out. We had a really nice big squeeze that went for an hour, and then we dumped the majority of the rest of the day, right? All the moves started at 10 o'clock. So if you were trying to participate from 9 to 10, you were participating in a balanced state of the market. We were at value, right? We had already run ES and SPY had already made it to those really big orders at the top side. SPY was like 49.50, I think, or ES 49.50. We had already run up there and smacked those big orders. So we were already sitting pretty at value and hanging out. So we needed a news cycle to come in and kick in the imbalance to bring in some extra orders. But I'll expand a lot on that, right? So when an auction moves, all auctions, including like fair auctions, market auctions, real estate auctions, they all move through the same cyclical pattern. They all go from value phases to value balance phases to excess to imbalance. So I have an analogy that I think really helps kind of tie that in, at least for me. And I know this seems like a lot in order to talk about stocks, but I need you to understand that if you really want to be a real, like, consistently profitable stock trader, very little of what's going to make you consistent at stock trading will have anything to do about stocks. That's the big falsity that kind of comes across this thing. You think you're going to be able to read some stock charts, look at some fundamental things, buy low and sell high, and you're going to make money. No, if you're going to day trade and you're going to retail trade, you need to become sensitive to the auction. Right? You need to know when it's time to buy and when it's time to sell. Not just the new high, not just the new low, but which new high and which new low and when and why and how long do I hold it? Should I keep holding it? Should I dump it? How long do you hold the position for? right? There will, all of these different questions are questions you will never know just trading a pattern, because in a pattern, you're entirely reactionary at all times. In this instance, and using some of these tools, you can actually be truly anticipatory. You can actually say, okay, I see large orders here. I want to see what happens when we get to these orders. I want to see, are these orders big enough to stop the price movement? Okay, yeah, really big orders, really big volume, stop price movement. So think of it this way. So real estate analogy. Most people are pretty familiar with real estate in one way or another. You've either bought and sold a house, or many people have come from real estate backgrounds and stuff like that. So the first thing we want to talk about is value, right? So let's say we're going to start off the real estate market a few years ago in my neighborhood, right? And back in like 2018, when I moved into my neighborhood, the average house in my neighborhood was buying in as a new build with a nice little lot and all of that stuff for around $500K US, right? And it's St. John County, Florida. You can throw a stone and hit the beach from here. Real nice house, 3,000 square feet on a nice little lot down here, and you can get it for $500,000. Not bad. Thank you, 2018. That's when I bought in. Boom, right? So now that was when we established value. And that happened for a long time. I mean, maybe for like a year or two, all of these houses were at this same kind of a value. And that's what the whole area really looked like, because there really was no supply or demand difference, right? There was supply coming out as the new builders were building. But as they were building, the amount of demand for those houses basically equaled the amount of demand that the builders were building houses and people were buying houses. This is value, right? If there was more demand from buyers, the builders could build more houses faster, maybe. But if they couldn't, then people would start buying the houses that are there for a higher and higher price. And this is what happens with stocks, right? With stocks, we have a limited flow. So we have a very specific amount of inventory. So if people start getting interested in buying stocks, right, there's not more stock being built. It's finite, right? So as people start to want the asset, the price immediately starts to value higher, right? So stocks are way more sensitive, right, than like the real estate market, because the real estate market actually has new inventory constantly being added into the market, which helps control how fast that price can happen. But as we saw in recent years, the demand for new housing paired with very low interest rates, right, allowed the market to go into a very aggressive bull market, if you will, for real estate. How did you know it was a buying market? Because we had way more buyers than sellers. This is our excess, right? When a market goes higher or starts to move higher is when you have sellers that are only willing to sell higher, and you have a high demand for that inventory, right? So if you have a lot of people who want to buy and your order book shows orders high on the order book, guess what? You're going up. So at this point, just find a spot to get long and go long, right? You bet. It's recorded, oddly. So pleasure. So you buy and it's going long, right? So that was the real estate market from 2018 till maybe about 2021. Right through 2022. Basically, there just wasn't enough inventory in my area, especially for all the people who are coming to Florida because they like sunshine and UV and stuff. We could not build enough houses down here. And because of that, the housing market, but pretty much across the whole country, right, just ripped and went nuts. Now, how do you know how did we know or start to recognize that this market that was so hot wasn't hot anymore, right? We started to notice because as you start to walk around your neighborhood, you actually see for sale signs. You actually have people advertising now, right? Before, people didn't even have time to put a sign on the street. People were putting signs like in their door, right? Hey, I'll buy your house, right? So I actually had a guy come up to my house, knock on my door and say, just wanted to let you know I'm buying houses in here. If you want to sell a house, here's my card. I will literally buy it for basically whatever you want right now. I think it was like BlackRock or something. But anyway, he just wanted the house. But it was very, very hot. But now if you walk around my neighborhood, what you'll notice right now that houses have doubled in price, right, what you'll notice is as you walk around, there's for sale signs all over the place, right? This is how you know you're starting to get into a buyer's market again, right? And on your order book, right, in Bookmap or on your level 2, what you'll notice is there are a lot of sellers starting to crowd the book very close to the price, right? So this is what we call excess, right? So when we're looking at our order book and when we're looking at an auction, excess is when we know market activity is about to incur, right? So when you're reading your order book in the stock market, your level 2, or when you're looking at real estate, you know stuff's about to change because there's a lot of signs, right? In real estate, you start to walk the neighborhood, there's for sale signs all over the place. So now if you're a real estate agent and there's for sale signs all over the place, what do you go tell your client who's trying to sell their house to do? Drop their price, right? You're going to ask them to go ahead and come down and lowball, right? Drop the price, incentivize buyers, right? And this is what happens in the stock market, right? When you have too many orders crowding, getting too close to the order, right, to the bid or the ask on the sale side, we're going to incentivize buying by moving lower, right? And this will kick us into our next movement or our next movement down, right? Stagnating price, right, or our balance phases is what sets up what will later become excess. But without excess, we won't move, right? So this is the big part of this really isn't to even teach you when to get into a trade. It's to teach you how to stay out of a trade. The biggest thing in the superpower that you will have as a retail trader is actually being able to choose when to participate with the market. Swing traders and long-term traders don't get that luxury, right? A swing trader has to buy, and once they buy, they have to at least wait a day, right, without hitting PDT, unless they're, unless they're willing to, unless they are also a PDT requirement that swing trades. But in most instances, a swing trader is going to buy the low or by the end of the day, and they're going to wait till the next day to sell, right? So all these other participants are handcuffed into positions. You aren't. You can get in whenever you want. You can get out whenever you want. And that is the superpower that retail traders most often get away. Your desire to participate with the market becomes your driving force rather than basically participating on your terms. So you only, and the reason why I'm going through all of this is because you only want to trade when it's in a position of imbalance. Especially if you're a momentum trader, that means you're moving from one area of value to another area of value higher or further away, right? This is a transitionary period where you get to move. For any of those who like read Wyckoff or Livermore, right? This is a transition between area of value to area of value where the price will move without lots of retests, right? Because it's moving now, it's going there. So if you can see the excess build on the order book, and then you can see the volume signal that kicks it into gear, then you can run that imbalance start to stop. And once you get good enough to recognize that you are in that imbalance phase and that you are auctioning, you don't need to partial, right? You don't need to worry about if it pulls back and makes a low, whether you need to get out or not. You can just sit back on your monitor and just watch the story of the market unfold as it goes. And even better, if something comes out that's a problem, like a news event happens, some kind of weird news comes out in a different country that suddenly spooks the market, you can read the volume and go, uh-oh, something just happened. My position looked like it was going great. Everything was fine. I was trending fine. I'm actually still in trend, but I just had a lot of volume hit for no reason on an order here. And it actually happens to be an area where we sold from before. You know what? I'm going to watch this. And if it makes a new low or if the volume increases on the sell side, I'm going to go ahead and cut this position. Right. And then you can actually start reacting to the market and playing the market as the market moves rather than reacting to momentary price fluctuations, which are highly manipulated. Right. The market's always moving just a little too high or moving just a little too low. Right. Trying to pop that high and pop that low to get the retail traders out. Right. It's constantly manipulating the tops and bottoms of candles. So you need to understand, is this a genuine move? Am I really breaking down or not? So part of the reason to do that is to really know your role in the market, right? You need to be aware of what kind of a participant you are, right? You are a what we would call a responsive participant, right? And a very small time frame retail participant, which means you have no ability to control the market or the market's movement whatsoever. So if you're anticipating movement, you have to keep that in mind, right? That you really have no weight here. All you can really do is just be a part of whatever happens. So another really big advocation for why you need to get dialed into reading what phase of the market movement the market's in, whether you're in balance, so you're at value, you're chopping, right? Or are you in imbalance? Is there excess on the book and you're actually moving somewhere? Really good to know, right? Because one of those is going to get you money. One of those is going to get you stopped out 4 or 5 times, right? And then frustratingly leaving, asking, why did the stock never break, right? The stock never broke because the stock was never going to break, right? It was in value. It never got enough volume. It had a balanced order book with orders flagging both sides. It was only going to ping pong back and forth between those 2 large orders the whole day. There was no point to even try to trade that stock. You shouldn't have traded that stock, right? But you burned a whole day and a whole lot of frustration hitting it. So, and I know, so, you know, some of these things can get really boring, but here's a point I want to show you here, right? So notice here, this really big explosion in volume that goes right up to this large R4 area, right? Notice how far up that went, and look at the amount of volume that came through when that happened. You're talking about 750,000 shares, right? In 1 second, blasted through the book. So if you think you've got any kind of volume or you can move things around, no, right? Value is established by large transactions and big players. All you can hope to do is be aware of it, right? And that's the big thing. There needs to be a lot of humility involved in being a retail day trader, right? You need to be a really fun analogy I like is, you know, if there's whales and if there's sharks, we're like that little fish with the like sucker mouth that like sits on the back of the shark. You know what I mean? Like that's like we're pretty insignificant there, but being aware of that role is super important because it's not a bad thing. It's actually a really great thing. It's just something to be aware of, right? You know, those fish that ride on the back of the shark, those fish can get so big that the shark actually will almost like drown because they can't move fast enough to keep water moving over their gills, right? Like that fish can get real big just riding on the shark, right? And we can too, right? We can do well, but the important thing is that that fish or that little pariah kind of like fish deal is no more going to steer the direction of that shark than we are going to steer the direction of the market, right? We are there to feed off of what is given to us, right? Not actually participate in the feeding, right? And that's really nice because the last thing I want to do is feed the market anyway, right? Solomon, how's it going?
Hey, hi Thor. I'm actually Kira from BBT, QIRA. But
Right on.
So I'm trying to put like a visual context to something we were talking about this morning when you were talking about like the market makers and that fictitious person who wanted Apple and was willing to pay the range. So would 750,000 shares in that candle, I can't even see what the range was, but would that be something that was representative of seeing those orders come through to fill an institutional order like that?
Yeah, exactly.
Okay. Because
Yeah,
you see it at the beginning, usually the opening candle and things like that. And Bookmap, I just reset and started Bookmap again. And I think it is a really good representation of like, oh, here's where they want to take it to. And they're going to hold it for much
Tesla,
longer.
for instance, today, right? Tesla sold off for most of the day. Tesla from the pre-market had one of the most bearish order books I've ever seen, right? It was just incredibly bearish. It was going down, right? So the question was, I know it's going down, so where can we get short on this thing, right? And that's that's kind of the thing here, because they were making it so obvious where they were willing to participate with it, that it was really like sometimes you're almost like, you can't be that obvious, can you? Like, are you going to really make it this easy on me today? Like, I feel like there's some trick or trip or something you're going to play on me right now. And then you're like, dang it, they did that. They really did exactly what they said they were going to do. Right. But that's why I said the general rule of thumb is price moves to size, right? For that reason. Right. So in this instance, what'll happen is they're aware of the order book structure, right? So they know that, because their algorithm can calculate it. They know that at this price level, there's 100 shares. At this price level, there's 200. At this price level, there's 1,000, 2,000, 4,000, 10,000, 20,000. And then at that target, right, I've got 500,000 sitting there, right? So they know once they get within a certain distance of that target, if they want to do it, they can just go, they just hit the button and then it's just going to blast the book. Basically, they're going to hit every share that they can take up to that price level, and they're just going to eat the whole book, right? But it becomes we call like if you read Anna Cooling, for instance, she'll call it like a buying climax, right, or a selling climax, right? So we're going up and we run up and hit the seller really hard, and we just get a ton of volume that comes off of it, and it's very unusual after that occurs for a continuation of that kind of volume. So normally after that selling climax, you'll climax and then you'll move up, but you'll notice as you move up afterwards, the volume just completely drops off. And that's because institutional participation is done, right? Everyone that's left is us, right? It's retailers that are still trying to buy a high. We're still trying to participate. We're still trying to get a little bit more of a move out of it. But in time, right, that no one else institutionally wise is willing to now buy any higher, right? You basically had someone that said, hey, I'm only willing to buy from here to here, but I'll take everything from here to here, right? So, but you're not going to get them to come up here now. So now the price is going to constantly come back to here. And if they can't get anyone else to buy there, well, unfortunately, it's going to have to go lower. And a lot of people don't understand that doesn't matter to that institution, right? The person who bought that big order, they were buying that order because it was going into a portfolio, right? It's going to be, maybe it's dividend bearing, right? Maybe their projections are 5 years, 6 years from now, after a split or two, this thing's projected to be worth whatever amount of money. So they're okay with buying it now, even at the highest price it's ever been at, because their model projects 10 years from now, it's still going to be worth double. Imagine the person who was called crazy because they were willing to add NVIDIA into their portfolio at $150, right? As it made the new all-time high at 150. You psychopath, right? 2 splits later and the stock being back at $500 or whatever it's at right now. I forget. Sounds like they did a pretty good job, right? Not bad. So, and so somebody on a larger time frame had that metric in mind. That's a little outside my pay grade. Right, like you need a college degree, and yeah, those jerks are allowed to use fundamentals. Exactly right, Eric. They can use the F word. But these are really smart people with doctorates and degrees and real like economic understanding, and they're using predictive algorithms and computer models, and we are getting ever increasingly more like them, right? I feel like the trend of the retail trader now, especially with tools like Bookmap, where we're actually looking at the DOM now, and actually paying attention to where, not only are we no longer reacting to their current volume, but we're actually anticipating potential volume now, right? And actually trading towards where we know they're motivated to be. And those kind of edges continue to come to the retail sector, especially as the costs and access to these things come into our price range. Like, can you imagine, like in Bookmap right now, for an extra few $100 a month, you can buy stop data now, right? So like I can actually see where retail traders are putting their stops out in Bookmap now, right? If I wanted to pay for that, think about how long the institutions have had that. Right, or the big guys. I'm sure that's been around for forever, right? And now I know it's been around for at least 10 years, right? So it's just one of those things where, yeah, this is a beautiful example of where they were, they obviously had an intention here, right? And they gapped through an area of low value so that they could get to that higher value order And then, you know, and then you can see this big volume. Look, and as a big volume comes in, and then look, as we start to push, right, the volume just completely tanks afterwards, right? So it's not like if this was an ignition for like what would be like, let's say a news catalyst came out and there was a big ignition, that volume would go up and then it would stay up. You would see like the average volume, like of the R-vol of the stock instantly. You can actually see before, after catalyst, volume small, volume big. Like it's really obvious. Okay, now we're playing, right? Wasn't in play, now it's in play, right? And so, and that's the thing, when it's in play is when that imbalance happens. And that's kind of what we're kind of like covering through here, especially, right? When we're in value, when we're balanced, is when we're at the area of highest transactional ability for them, which means they're not going anywhere, right? If you take an ATM machine and you stick an ATM in the middle of the Mall of America, you really don't need to move the ATM machine, right? You're constantly having people interacting with the ATM machine at that location all the time. So why would the market maker move the price if all the volume they need on the buy or the sell is here? Now that can either happen in a high volume, a high value area, or an area of low value that has low interest, right? Just because a ticker is in an area of low value doesn't mean it's going to move. If nobody wants it at all, some junk stock, right? Or a penny ticker or something like that no one cares about, right? It just sits down there because no one's interacting with it. It really doesn't matter that it's in a low value area. It's not being participated with, so it's at value. That is its current value, right? No one wants to buy it. No one wants to sell it. It's at value, right? So there are two states of value and balance, right? Value is that state, right? Balance is when you have an equilibrium, right? So when your number of sellers and your number of balance or your number of buyers are equal to each other. So you can have a value assertion that can happen in high value volume or low volume, right? It really just depends on balance. Is there an equal amount of selling demand to an equal amount of buying demand? And if that's the case, you don't go anywhere. You just stay put, and you will never go anywhere. And this is where a lot of retail traders are going. They're going to get eaten for lunch because you're constantly trading in a ticker that is not yet ready to move, right? Okay, I'm long. It's going up. It's going, oh, it's coming back. All right, I'm out. I'm going long. Oh, it's coming back. I'm going out. I'm going, oh, all right, I'm tired. I'm going to bed now. I'm just exhausted. Oh, it ran like 5 minutes after I quit, right? There was only really one good time for it to go. And when you look in hindsight, you'll go through and you'll see, oh, look, it made a new 5-minute high. And when it made the new 5-minute high, look at that giant spike in volume that came through, right? And then the whole volume profile went up by about 50% per average minute. And then the thing just started running north, right? And you'll say, so that's when it went into play, right? You see that enough times and you'll really start to buy into what I'm selling here. Because you'll start to say, man, if I have just waited and that'll be the story of your life in the beginning, because once you start to see this stuff, you'll really start to kick yourself because you'll go, oh, if I had just waited 5 more minutes, I would have had that whole move. Oh, if I had just been 5 minutes faster, I would have gotten that whole move. Why wasn't I ready? Right? You weren't ready because you will be once you start to look and you start to see these signals. So all right, let's go ahead and move. So I kind of talk about the market makers and how they got paid a little bit already. So I'll kind of push through this slide, but just remember, market makers are in the middle of every single transaction. So when you're making a transaction, you're not transacting with me, right? You're transacting with the market maker, and then I'm transacting with the market maker. They are always in the middle of every single trade. So when you see buying and selling, you're seeing buying and selling from the perspective of the market maker. So just keep that in mind, right? There are times when you will buy and you actually buy higher than the price is even selling for. That's because you paid the market maker, right? And you bought it from the market maker at a higher price than it was currently selling because you wanted to get in now, right? Danger of market orders, right? But keep that in mind. Market makers get paid by doing transactions, and they're always going to be motivated. So we talked a lot about imbalance, right? Imbalance occurs when there is an excess of supply or demand. During the opening 15 minutes, in most instances, like I said, this is an imbalance phase or our price discovery phase, or what we like to call our transition phase, right? If you're into Anna Cooling or you're into like Wyckoff or Livermore, right? They call it a transitionary phase, right? So it's marked by higher than average volume. And the trades in this range taken are trades that can be based on momentum. If you are a momentum trader, please hear me and hear me now. This is the only phase you want to be targeting. So you actually do want to trade in the first 15 minutes for your 5-minute ORB if you're a momentum trader, because you're gonna play the imbalance out to the value area, right? But if you open too close to value, and this is why it's important to learn what that means, right? If you open in a selling range and you open up in mid-range and you have to squeeze first, there's not enough move there for you to play a momentum play on it. So you need to let it exhaust itself off of the large orders and play the failure, right? So you would be playing short on that instance. You would actually let it come up and distribute, create a selling climax, and then play the failure of that sell. Being a momentum trader does not mean you trade fast, right? The momentum trader means you trade movement, right? You are a river rafter in the stock trading world, right? The river is always moving, right? You want to get in the river while the river is moving, and you want to stay in the river as long as the river is moving. If the river is not moving, it's very boring, so you want to get out, right? If the river's ever going against you, you want to get out. You find value by transactions, large orders, big orders, whether those orders are, and we'll talk about VPOC a little bit here, but whether it's the orders that are spread out over time at a particular price, right? Or if they're orders that are at a specific time, high volume at a specific price, right? Either one of those will work for establishing value, right? So value can be established either slowly over time by the same price being manipulated over and over and over again, or ticked over and over again, or value can be established in an instant by hitting an incredibly large buyer or seller, right? Either one of those will work. So I want to show you an example of what an order book looks like when it's in imbalance phase, or it has excess to the top side, right? So this is an example of a bullish order book, right? On DOS's level too. You can see here, because I'm using a highlight feature to show you where the large orders are, you can see that to the top side, all of our large orders are sitting on the ask, and they're spread out evenly across the ask. They're not grouped on the ask really tight to the price. They're spread out across in limit orders to the top side of the price, providing very nice selling opportunities for anyone who wants to buy. And since our demand at the time is hitting the bid on this one, pretty easy to push up, right? We have a bearish example here. This is PLTR, but you can see here our order book is imbalanced significantly to the downside, right? This order book would sell down, pullbacks come back and hit the larger orders as we drop. But you can see here the transactional potential being offered is here. You would want to trade either of these two books, right? The reason why you would like to trade these books are because these books are obviously imbalanced in one direction or another. Think about Tesla today that I talked about, right? Or Tesla was my favorite today because the order book was really bearish, right? It was very obvious to read. In Bookmap, this is what that looks like. This is an example of coin from a little while ago. I think it was from July. You can see here on this day, Bitcoin went into play for a little bit in July. As soon as the stock market opened, if you were paying attention to the order book and what phase we were in, you know that we opened in an imbalance phase and we were very aggressively buying. If you look, this is what the order book looked right at the open. There is zero question about which direction this stock is going. This stock is going up, period. There is buying and there is a bullish order book. The question is, when do I buy, right? When can I get in and manage my risk? Because I know this thing's going up. The question is, can I get in? Can I afford to get in at this price, or do I need a pullback? Now we talk about where does value get established, right? Every single one of these areas here are areas of value, right? So the larger the selling level, the more likely the impact will be to the price action. But as long as buyers can continue to come in and buy, the value can continue to move higher and higher. And you actually can see as this stock moved on throughout the day, we actually put more orders on to the top side, which actually did allow us to break out and continue going, right? So, but notice here, what happened when we hit this order right here? We had a very large order to the top side. too big of an order to the top side at the time. And because of that, we actually exhausted here, and that created balance, right? We no longer had enough buyers to go through this, right? And because we no longer had enough buyers, this actually temporarily sent us into an imbalance phase in the other direction. We actually started to sell off because we couldn't find enough buyers. Now, this sell-off was caused by people who had bought earlier, right? These aren't short sellers coming in. There's not enough volume. These are just people who were buying before who started to sell. They probably bought too tight to the price, so they had to cover for loss or something. But this allowed the price to come back down, and then look where it bottomed. Wink, right there. Do you think that's a coincidence? No, it's not. Whoever bought that level before was willing to buy more. Remember this thought when we were talking about before, they're willing to buy all the way to 120 bucks or 126 bucks. This person was obviously willing to buy all the way to 82. And when the price came back to 82, they were willing to buy more, but they certainly weren't willing to sell. So we couldn't get enough selling to go down here. So we pulled up and look, we came back here, boom, big buyer. Right, we had a huge buyer come in and really set that downside value area. We struggled a little bit and then boom, went ripping. Look, as the buying came in, we bought through that level, right? This was a bullish book all day long. At no point in time would we have attempted to short this book, right? And that's really stinking handy. All right, let me push through a few more and then I'll try and hit some questions because I'm lagging a little bit behind on getting through this thing. You know, feel free to leave it on there and it'll leave a Q in there and then I'll hit you. So here's a good value assertion here. Notice how we sold off here. This chart here, by the way, is from my Tron chart days. I'm an 80s baby. So I went through a small time period for about 6 months where I was trading using what I called my Tron charts. But I decided to leave some of these charts in here because I just like you guys seeing that the fact that this stuff worked like 2 and 3 years ago the same way. But you can see here, look how we waterfalled into this large buyer, right? That buyer was a value assertion, right? When we hit that established value to the downside. If you were looking Wyckoff or Livermore, this would be a spring, right? A Wyckoff spring. Or something or of that nature. We dropped down and hit the large buyer and then immediately, right, started rallying off of that buyer. That's our downside value, right? These levels are levels that are very, very important because if you go to a larger time frame, that was an area where it bought off of from the day before. So these levels can actually get really nice to watch. On Bookmap, there was already there was obviously a buyer sitting there as well that we would have seen on Bookmap. So here's another instance you can see here. This is a value assertion over time. We did have big volume here as well. That set value. Notice how we start ebbing and flowing up around that area. So value is that assertion, right? So like I said, value can be established in one big burst, or it can be established over time, right? The basic formula I like to use kind of in my head, which got skewed here, is value equals price times volume over time, right? So made it up myself. So basically, like the thought I have behind it, right, is value, right? If you have a lot of price and a lot of volume that happens very quickly, that can be volume. Or if you have a lot of price and a lot of volume that happens over a very extended period of time, that can also be value, right? Either one of those. And think about accumulations versus distributions here. These are value areas, right? Which is why they're so choppy. Look here. So I want icebergs are something you need to be paying attention for in general. An iceberg is an off the book seller, right? The reason why icebergs are hard to spot is because you'll notice you start to sell and then they'll come on afterwards. So it's an iceberg, right? Because all the transactional potential, is kind of being hidden from you. So you kind of get this little bitty piece of it and all of a sudden it drops. These things can be a little hard to anticipate. But just be aware if you start butting heads into a big seller or something's going on, you're not progressing, be careful of these guys because they affect value. The only reason to hide your size on the order book is because you're humongous, right? If you're you and me, we're not worried about hiding our size on the order book, although we can. If you go into DOS, your display field on your montage will actually allow you to hide your size. So if you wanted to only transmit 10 shares at a time, instead of transmitting 100 shares all in one bulk order, you could certainly do that just for the fun of it. But in the instance of an institution where they're trying to spread out maybe hundreds of thousands of shares over the course of one price, they often don't want to just let that hand reveal itself, although sometimes they do. And then they'll actually start doing this. This often happens when market makers are competing against other market makers. So don't forget that market maker on market maker crime is certainly a thing. So there are times when market makers are working conjoining portfolios, but they're working in opposition of each other. And that's a lot of the times when these big wick outs and lunges can happen. It's because the market makers are kind of messing around with each other. So we're going to end up running a few minutes long on this one because so if you got to bail, let's record it. If not, I'm going to keep rolling. So you can see here. So now we're going to talk about balance. Right now, the balance phase, right, is this choppy phase that we're talking about. If you're looking at the level 2 on DOS, right, the order book on your level 2 is either going to be completely congested, which means you're going to have orders all over the place, or it's going to be, which can look like this, right? So look, even in this instance, right, you've got orders to the downside and orders to the upside. Although this one's a little bearish, right, it's still a little too balanced for me, right? This one is obviously incredibly balanced. It would be very difficult to figure out which direction this stock's going to go in. And in all reality, neither stock is going to go either direction in that moment, right? This stock is consolidating. It'll actually go into a breakdown a little bit later. I just know that for a fact because I traded it. And this stock goes nowhere. It actually spends the entire day and only moves about 10 or 15 cents in either direction, constantly chopping up and down inside of these orders, right? So this is an example of that. Notice how low the volume gets during these consolidatory periods. And this is the big thing you need to worry about when you're especially a momentum trader, right? But everyone needs to be aware of this. Nothing worse than being liquidity tied in a position when other people's tickers are moving and yours isn't. Right? This ticker gets this really big giant movement, but within a few minutes, it's already completely done for the day, right? From this point on through the entire day, this ticker never moves more than that range right there, right? That stinks, right? So basically, if you didn't catch that opening break, right, at the beginning of this one, you're out of luck. Right. But that's important to know. If you're holding this position also, and you're thinking, hey, I got long here, I'm going to hold this. When do I get out? That's when, right? When you get into a position and you're just stuck here in this range and your volume goes down to nothing, it's not going anywhere, right? Might as well get out of it, put the money in, look for something else, stop trading for the day, or just wait for the volume to increase. But you can see here, this one just kind of stayed like this for the rest of the day, right? All right. Excess, right? So this is when we're moving from one to the other, when we actually move from these areas. So notice this is our balance phase. Notice the low volume. Notice how the volume increases as we build excess and start to transition. See what I mean about the volume, right? This is a real big thing. Consolidatory period, you'd be stuck here for a couple of hours, but if you get your trade right there, because you see the volume starting to increase, right? So you take your trade when it makes that new high there, your stop's right there, boom, you get this move from here to here. And that happens, right, in that amount of time, right? So in a half the time or a third of the time, right, if you could have bought this low, sure, you could have bought the low, right? But you could also be stuck in this position for a really long time. You know, if you feel like being in a desk all day, cool. But if not, it might be one of those moments where you just say, hey, I'm going to come take a look at this one a little bit later. You know, you take a look at it every 5 or 10 minutes and see if anything's changed. And then maybe you got a shot at looking this. I like using certain volume triggers that are out there. I don't have one in DOS that I like these days, but a buddy of mine configured one that you can set on, I forget, I think it's TOS, I think, where if the aggregate volume increases by a certain amount, it'll trigger. That's pretty cool. I'm normally well done by trading by the time you get this long in the day. So real quick hit on VPOC. So VPOC is volume point of control, right? Me too, Mike. But the other one is out there on the tube. It's similar. So VPOC is volume point of control, right? So when I talk about where the ATM gets moved to, right, VPOC is the location of the ATM, right? So VPOC basically looks across a time frame, and wherever the most up and down ticks have occurred, that's going to highlight as VPOC. So VPOC is dynamic. So if you're on a small time frame, it'll be in one spot. If you're in a big time frame, it'll be in a different, because the more data you add to it, the different areas of value you're going to see, right? So VPOC on a 1 minute can be at one price, and then VPOC on a 15 minute can be at a different price. It's all value. It's all right. You're just micro to macro values. I have this slide here if you want to see how my VPOC is configured, or at least was at the time. So nice little example here. So notice on Tesla here, this is a nice fade that I played off of a balance concept. So as I'm looking at the order book, I can tell I have a fairly even distribution of orders, right? So I'm really kind of thinking we're probably going to stay inside the range and we're not going to break out, right? So what I want to do in this scenario is I either want to go short from up here or I want to go long from down here, right? Because basically I want to trade the transitionary period between these two areas of high value, right? So as we came off of S3 and rallied out to PDC, we kind of set an isolated pivot there, right? Or we're starting to right off of that daily level. So I went ahead and went short. My stop could just be PDC in this instance, right? And we got a nice drop back down to the lower side of the range, right? This is a really nice move, right? And what I could see here is, although we were moving up through these orders, we were actually selling a lot more than we were buying, right? So this is one of those moments, right, where I talk about where a momentum trader or someone who is, playing patterns, right? You see this movement up here, you see this big drop back here, comes up here, hammers, and then makes that new high, right? So you go long here, it pops up, turns up, and then immediately sells against you, and you go, what the heck, right? I don't understand why this sold against me. Well, it sold against you because there were no orders up here, right? 226. Right, is right there. So your larger order set was right at 226, right underneath the opening price, right? This wasn't going to go up because in order to climb, you got to have a ladder, right? So we didn't have orders. And we didn't have volume, right? So our volume was actually declining, right? You can actually see this average volume line here. Our volume was actually declining as we were pushing up, right? And so we had divergent volume, right? And we moved right into previous day's close, did what I would consider to be kind of a volume anomaly, very big move on what was really kind of just average volume, right? And then this big inverted hammer here, or a hangman candle, on what I would consider to be elevated volume considering, right? And then again, no orders up here. So where were we more likely to go? Break out, or were we more likely to fail? We're more likely to fail. So we played the fade back that direction, right? Another instance, NVIDIA from a prior life. This is NVIDIA from what is this? August. Opened here, squeezed back to R3, shorted R3, partial, and then partial at S3, right? Why here? Well, first, it took us a little bit of while to get our prices really set out here. You can actually notice here up at the top here. See what I mean by price discovery? See how our orders are actually coming on after the fact, right? So we can actually see as we're starting to chop here, notice what happens to the downside. We actually build a pretty aggressive ladder, right, to the downside. So I feel like, because I see a large amount of selling and I have a pretty bearish ladder at the time, I just needed to squeeze up so I can sell. Now we're under R3, so I'm just looking for shorts in this chart, right? Because it's an area where I like to sell. So I've got selling, I got a selling range, and I've got a bearish book here, right? So I played towards it, and look where we bottomed, right? Right off the order, right? A lot of stock trading is less complicated than you may actually think it is, right? And this is one of those instances, right? Where did it go to and where did it bounce off of? Right where it said it was going to, right? There was large orders to the downside. We ran out of orders past that, so we couldn't keep going lower, right? We didn't have buyers that were willing to buy lower, even though we were selling very aggressively, through the buyers we had. So since we ran out of buyers, we stalled and short started to cover. These are short covers, right? And the short covers came in and started to squeeze. Now, why did our price not move back up faster? Well, look at the order book, right? Empty, right? We didn't have buyers coming in to buy to create a ladder back up, right? These were all sellers that sold, right? So we didn't build a order book here, so we couldn't bounce that order, right? QQQ, short off of a breakdown on the retest of S4 with a new 1 minute low, right? QQQ reads a little nasty on the book map, my apologies, but you can still see the same thing here. Look how obviously bearish the order book was on Qs on this day, right? So we had an order book that was bearish, so we had excess to the downside, right? Our selling activity, right, was more selling than buying. So we moved downwards, and guess what? We started in a selling range, right? We opened under S4, we squeezed back, and we sold. So this one had it all, right? We were in a selling range, we had a bearish order book, right? And we were being imbalanced to the downside, and we had plenty of volume down into these large orders. So now that we've seen through some examples, I'll do a couple minutes worth of questions, but I'm really hoping you're kind of seeing how these phases kind of line up and these kind of things start to come together. I know market auction theory is kind of like another language when it comes to reading the stock market and stuff, but I promise you, if you take the time to go down the rabbit hole a little bit and geek out a little bit on some of this stuff, you're going to, the rewards that you're going to get from it will be profound in a way you will not understand. Like there is a big difference in the amount of confidence and control you feel when you can actually pay attention and read the order flow of the market. And for me, I kind of, the difference for me is the difference, and my buddy Mark, to kind of quote him on this, kind of makes this analogy. It's, as you learn this, it's like you're in a bus, and it's like going from sitting in the back of the bus to sitting in the front of the bus. Like you're never driving the bus, but in the beginning, you're sitting in the back and you really just have no idea of what's going on. You're just constantly reacting to the swing or the motion of the bus that's going around. And that's most traders. As you start to develop these techniques, VPA auction theory, and reading the order book and tape reading and these things, you actually start to move closer to the front of the bus, where you can actually start to see not only where the bus is turning, when he's turning the wheel, but actually his GPS and where he intends to go and how he intends to get there, right? So if you can start to see these things and start to recognize them, you will see the reward come back to you in not just a hit rate or just a P&L figure, right? But it'll actually come back in the way you feel about your interaction with the market. You will feel less anxiety as you interact with the market when you understand why the market's doing what it's doing. Not one of those people yelling into the wind on the Twitter, why did SPY drop 15 points 2 minutes ago or whatever, right? We know the reason why, right? We knew the news event that came in. We knew what the order book looked like. We knew what the fundamentals of the market were at the time, right? And that's why. So hopefully between all of those things, it'll really help you all out. So a couple questions real quick, and then we'll move on. Nathan, you still got something for me, man? I left you hanging for a while there, brother. Sorry about that.
Oh, no, no worries. Can you hear me?
Mm-hmm.
When you were talking earlier about, the momentum traders and looking for where the cans are and where it's opening in value, that's where I'm having a hard time using the buying selling ranges with the cans in my momentum trading, like a 15-minute opening range breakout, trying to understand more where it opens to where price is going to go to look for that right breakout.
That makes sense. So for me, like obviously, or not obviously, but trying to pair daily range with intradaily range will make it a little bit more explosive. So if you're in a buying range on your daily, or an area where you can expect to see buying on your daily, that should allow your intradaily ORB to be more powerful. But you have to, the thought is like if this is like, let's say this is 3 and 4 and you're going to do an ORB up, right? Ideally, you're going to want to buy it when it opens somewhere north of the 3 to 4 range, and you're going to want to let it come down, hit, and then buy that as it comes off of it like that. So now I don't know if you just buy the break or if you buy the retest, depending on how you like to play the break, but that's really up to you. But at this point, this is going to be my ideal spot because, and obviously with a bullish order book being ideal as well, because you're going to have orders to the top side, but if you have a wide cam range, right, then your expectation for this move will likely be to, 3 or 4 the other direction, right? Because you're probably going to do some kind of an inside traverse and come up here and find value here. So the difficult part in the timing is, one, not being too tight to the price, because what can happen often when you're buying in these ranges is it does this initial break and then it comes back in, right, holds, and then comes back out like that. I've noticed that happening more often. That back test used to be a lot cleaner, and I don't know if that's something for us or not yet. I'm actually still sussing that out a bit, but it seems like it wants to pull back a little bit more these days. But it's still within like the 33, like, it's still within like a Fibonacci style, like, it's not breaking so far inside that next range that it's like ridiculous, but it can be concerning if you're playing a break, because you don't get that pop that it used to be. It would come out of here, and as soon as it hit that, it would pop way up here, and then the test would happen like maybe here. Now it seems to be happening a lot closer to the price. I think part of that's just because of how high we are in the market right now.
And that's what I was talking about earlier today, is you start to get it, and then it's coming back in, and then it's just chopping around, and right between
part of that, I
entry
think,
and
is
my
because of
stop.
the markets. The market is kind of in a selling range on the daily, right? So basically the whole market's a selling range for me right now, basically, more or less, other than maybe Tesla, I guess. But Tesla is so low, it's kind of a selling range right now. But I mean, it's the whole market for me is so extended. I think washouts are just going to continue to be a thing until finally this market gives back a reasonable amount of movement. Because right now what happens is we're basically pushing higher and higher on what seems to be decreasing volume. Anytime the volume hits, it hits the sell. It's very distributionary. Anytime the volume hits, it's hitting hard on the sell. So we get these really heavy washouts that are going further than expected. And I don't know if it's just, at first I thought it was bears being aggressive, but at this point, I don't think we've got that left. I just think we've got so many people who are just kind of waiting to sell, but they're just constantly holding, that these we don't have enough buyers high. So when a washout occurs or the price liquidates, it runs the downside order book. And if there's not a lot of buyers sitting in the order book, then it's going to dip further, right? And that's the problem we're having. And as it breaks, we're not having enough buyers come with it. So it's not getting as far away. It's like more timid price action. So that the buyers aren't really buying that break like they used to. So it really has to come back, test, hold, and then do it again to like really, let's go, people. I think part of that is because of how extended the market is. I think we're so high in ranges right now that you're not really getting institutional support from these buys right now. Most of your institutional players are trying to sell, and they're trying to goad retailers into buying high, basically. So you're lacking downside bid, and you're kind of getting a little bit more of that bid side selling whenever you hit those areas. And it's unfortunately, it's just pulling it back a little bit too far. So I to combat that, you may want to try looking at letting it break and then pull the retest. And then if the retest holds, try and throw it off the retest if that still sets in your metric. If not, maybe again, either down your risk a little bit so you can take an extra stop with confidence, knowing if it breaks and hits and then re-breaks, you can get back in, or knowing that move, when you nail it, will likely be a full traverse that will make it the majority of that move, if not all the move. Be willing to roll your stop ever slightly wider than you feel comfortable with, expecting a bigger move. Because those inside traverses, once they land, have been huge. I mean, they're especially to the bullish side. Once they finally get going and go out, they're great. They're just kind of a pain in the butt to get into because they continuously just seem to come back a little bit further than I want them to. I've had that trouble with my longs off of S3, even though I don't play them in like as a breakout. I still have that issue where I'll buy right off the bottom of the range. I've got the best price all day, I feel like, and the thing comes all the way back down, knocks me out to the penny. Kind of a little like feeling headhunted here, personally, kind of like gone after, and then it bounces off me and runs. So I definitely get where you're feeling that, but I think that's the reason. I think it's that lack of bid structure closer to the price is letting it fall. All right, let's see. Let's go ahead and do. Let's hit Gurinder. What's up?
What up, Tor?
How's it going, brother?
I see. You know, you always say that, like, even the stock is going up, you say it's the selling volume coming in. Is that you see on a book map that the orders are getting filled when the stock is going up and there's no aggressive buyers coming in? Is that how you tell that, or?
So there's two ways that I read it. One way I read it is on Bookmap, which is, Bookmap makes it pretty easy because red bubbles means market selling. So that makes it pretty easy. But the other way is when I'm reading the tape. So when I'm looking at the tape, when we're pushing, how I read it, it's very kind of weird. I'm not as good at this as Paris is, but basically what happens is I'm looking at the volume pressure. So as volume comes through, right? If the volume comes through and I've got an order above me, if that volume is coming through, and as the volume comes through, it's green, and I see the volume like spinning quickly and moving quickly into the order. So like the order's above me, I'm seeing green, and I'm seeing a lot of volume in green. You can almost assume 9 out of 10 times you're going to break that order. You're going to go through it. Because they're working very, very hard into that order, and they're buying into that order. When I'm saying we're selling, is what you'll see is as we approach that order, we either interact with the price or actually stall ahead of the price and don't interact with it. And I start seeing as the green comes in, we don't move up. We just sit and stall, and the green comes in on low volume. And then when the red comes in, the price washes away. So like when I see the red hit the tape, right, the price actually falls. And then when the green hits the tape, the price stays still. And sometimes even red hits the tape and the price actually lifts while I'm seeing red hit the tape, right? So we actually have price that is ascending right now, but it's ascending while the majority of our volume is selling, right? So I'm saying, all right, they're struggling to move up here, and they're actually being burdened with additional selling volume. If that volume doesn't go green, right, if they don't get buying volume on the market, they're not going to be able to go up.
Nice. What sort of package you have on Bookmap?
Bookmap, I still have the TD cheapo version that I got through TD. They still haven't kicked me off of it for some reason. So which is great. But when I did have Bookmap, I had global. I think I had Global Plus when I was subscribing for it a long time ago.
Okay.
But anyway, everybody,
me and you are the only ones I know that still have that through TD.
They have cheap TD. That's awesome, man. Until they kick me off of it, I'm hanging on to it. I don't care what they say. They'll be like, it is 2035, and Thor is somehow still getting free Bookmap from TD. He doesn't even have money in that account anymore. I don't know what's going on.